What if I told you that buying your first home to live in might not be your best financial move? Instead, consider this. Buy an investment property that cash flows and use that money to pay for your mortgage. In this video, I'm going to explain how investing in cash flowing properties and using that money to pay for the home you live in is the smarter option. And stick around to the end of this video where I share 3 spots you should consider investing in Canada. So you might be familiar with Robert Kiyosaki's book, Rich Dad, Poor Dad, and if you're not, it's definitely a book you need to pick up and read. The whole concept is about buying assets and not liabilities. So when we think about our primary residence, our home, everybody says, well, that's your biggest asset. Your home is your biggest asset. Well, Robert Kiyosaki will say it's actually your biggest liability. And the reason is because your mortgage is actually what costs you the most money. So every month you're paying 40, 50, maybe 60% of your income to that mortgage. First thing we need to do is break down what is a cash flowing property. What I'm going to show you now is some real live listings on Realtor.ca of properties that may produce cash flowing scenario, as well as a breakdown of your mortgage payment, how much it would be and how much you're expected to generate in income on this property. Some real common things that get missed when we're talking about income producing properties though is, well, who's going to manage the home? So if you don't live in the area, because sometimes it makes more sense to buy something out of town. So who's going to manage the property? But you might be looking at property management fees. You also have insurance, you have taxes. There's other things to consider. I'm going to break down all this for you on a property that I find and show you how it could be your first income producing property. Now you're going to say, well, that's great, that's dandy, but that's only one property, only generates $1,000, $1,500 a month. But the goal is to own multiple properties. So you buy the one, onto the next one, onto the next one. Now I like to use Ratehub.ca when I'm looking at mortgage payment calculators. I find it's a really nice website. So we've got your purchase price, you've got your location. Like I said, I'm in Victoria, BC. We've got here down payment. So we got 6.5%, 10%, 15%, and 20%. Now what it's gonna show you here is CMHC. If you're under 20%, CMHC is required, and what it essentially is insurance for the lender if you default on the mortgage. Meaning if you don't pay your mortgage, the lender can go to CMHC and recover the funds that are lost from that loan. We can only do a 25-year amortization. As you'll see here, I've got it all set for that. And then the mortgage rate. You can click custom, and if you go up to here, it'll show you rental, and it'll show you the best rates currently offered from the bank. So we'll start with TD as it's a reputable company. And then down here, our payments monthly, and then here at the bottom, of course, what our payments are gonna be. So that's what we're gonna use to calculate if this property is cash flowing and makes sense. Go to Realtor.ca. It's a pretty easy website to search for listings. I'm on the website. I've searched Victoria and it's brought me up a map view, which is what I like to use. You're gonna wanna go to filters, turn on the filters. Make sure your property type is as residential. Set your price point. I'm gonna go max $1 million. And I'm gonna set the ownership as freehold. Freehold essentially means that you own the property versus there's gonna be different ones like leaseholds, meaning that you have a lease on the property and you don't actually own it, you just own the actual unit or the building. But in this case, freehold is typically what we wanna look for. Now that we've set all our filters, you'll see it's populated a list here of different properties for sale. We've got 59 total listings. I've set it here for lower price. I want it to, give me the lowest price houses first. So what I see here, there's one on Galena Road, $699. Click that, it's gonna bring you to the listing. I'm looking through, what I'm looking for is details, size of home, everything else. So we've got 2,366 square feet. It's got potential for an in-law suite. If you can't get a renter in there right away, it might not cash flow. You might have to invest a little bit of money, but let's run this one and see what it looks like and assume that we're gonna have to put $50,000 into putting a suite in the basement. The price of that home is listed at $699. Let's say you've got an amazing real estate agent like myself and we've been able to negotiate it down to $660. Your mortgage payment is $3,122. We've gone through the mortgage calculation on Ratehub.ca. We've looked at Realtor.ca and we found a property that might work. Next, what we want to do is we want to know what the rents are. Now, if you're familiar with the area and you live in the area, you may already know the answer to this question, but if not, you can go to a website called rentals.ca. When you get to rentals.ca, you can go down to rent report in the menu, and it says here it's been updated on August 2024. We can scroll down here, and it's going to give you a list of all the major cities in Canada, and it's going to show you what the rents are. So here we've got in Victoria, I can highlight that for you, and we scroll up, a 1-bedroom or a 2-bedroom. In Victoria, average is $2,189 for a 1-bedroom and $2,797 for a 2-bedroom. And you could imagine if it's a 3-bedroom, I'm gonna say we're gonna be in the $3,200 to $3,500 range, depending on the area and depending on the quality of the home. All right, so we found a property that might work, but we're not entirely sure, so we need to run through the numbers and make sure it cash flows. If it doesn't cash flow, move on to the next one. So when we're at Realtor.ca, you'll see here annual property taxes are $3,458 a month. So we need to take that, plug it in our calculator, $3,458, divide that by 12 months. That's $288 a month. I'm gonna round up to 300 just to be safe. So we'll go over to our notes, we'll put that in there, taxes, $300 a month. We knew the mortgage was based on 20% down is $3,122 a month. So we can go back to our notes and we can put that in there as well. Now insurance, you can call around and get quotes. Very, very easy. So I would suggest you do that. Because I know the market quite well and I know what insurance costs in Victoria, I'm gonna put $200 a month to this. Now maintenance, for me, it's cash flowing, meaning if I'm making $1,000 a month off of this property, I don't intend on taking that $1,000 a month and spending it on jewelry and cars and these things. I'm gonna put it in the bank until I've got a good buffer that I can work with. And actually, I'm gonna use that cash flow to buy my second property. Obviously, if something happens initially, that's going to be an issue, but hopefully you've got some money put away just in case. So I've got $0 for maintenance. Now gross rents, when we went to rent.ca, we saw that it's roughly $2,189 for a 1-bedroom and $2,797 for a 2-bedroom, meaning a 3-bedroom is going to be in that $3,200 range. Because this home has 4 bedrooms, 3 bathrooms, go with the 1-bedroom for the basement and then the 3 bedrooms up. I'm gonna go on the conservative side and say $2,000 a month for the 1-bedroom. And then for the upstairs, for the 3-bedroom, I'm gonna go ahead and go with $3,200. That puts us at a total of $5,200. We bought our $5,200. Let's go ahead and minus all our expenses. That's leaving us with a profit of $1,578 per month. Now you've got this property that's making you $1,500 a month. What do you do with this? Well, personally, I'm gonna put it back into my corporation and I'm gonna reinvest it. What does that mean? I'm gonna get a hold of my financial advisor and he's gonna put it into certain funds that are gonna help it grow. Now, if we go to a simple compound interest calculator with a $0 investment and we put $1,500 a month in, and let's just say that we're going with a really conservative rate of 8%. Now, my investments do an average of 12 to 15% annually, but we'll go with a really conservative number. We've got a yearly interest compound and I put it at 5 years. The reason I did 5 years is because that's the maturity of the loan that I took out on the mortgage. As you'll see, the total value of your investment is $109,000 after 5 years. This is the part where you say, wow, that's amazing. I made $109,000. But there's more to it. You did not make $109,000 because the home has most likely appreciated in value over the course of 5 years. So let's just say that the home increased by a value of 5% over that 5-year period. So if the purchase price was $660,000 times 1.05, 5%, that home is now worth $693,000, meaning there was $33,000 in profit made on that home. I would say that's a modest estimate, 5% over 5 years, you're probably going to see more appreciation depending on what market you're investing in. Regardless, you've made $33,000. Now you take that $33,000, you add the $109,416. Now you've made $142,416. Again, you're not finished though, because the renters have been paying your mortgage. And when they've been paying your mortgage, they've also been paying down your principal, the amount that you owe. After 5 years, you don't owe $660,000. If we go back to Ratehub and we scroll down, there's a little thing here called amortization schedule. So as I mentioned before, we had amortization at 25 years. That's how long it's going to take for you to pay off the entire mortgage based on that schedule. But you're on a 5-year term. After 5 years, you have to remortgage, and hopefully you remortgage for 20 years, and then after another 5 years, you amortize for 15 years, 10 years, and you actually pay it down. So if you scroll down, we've got the amortization schedule here. And if we go down here, it shows you what your balance is on the mortgage after every year. So at the end of 5 years, or the total term, you've paid down $220,000. Well, you haven't paid down anything. Your tenants have paid $220,000. The principal paid is $75,196. You only owe $566,588 on that home. You've also made another $75,196. We add that onto our total, and now look how much money you just made in 5 years off of buying an investment property instead of a principal residence. And then you'll say, well, yeah, but you only make that much money if you sell the home. Yes, you're correct. However, now you have leverage. You can remortgage that home and you can access that equity. And what that equity is the amount of money that the home is worth compared to what you owe. So now that amount of money you can access to buy the second home. The part that people really get hung up on all the time is, well, I can't save $120,000 or $130,000 for a down payment. I understand that. It's not easy to save that kind of money, but if you're not doing anything, you're never going to get ahead. You have to start taking massive action to get that first home. Maybe it's not a house. Maybe you have to start small. Maybe it's a townhouse. Maybe it's a duplex. A lot of duplexes are suitable and they're a little bit cheaper to get into the market. Or maybe you look at a condo. Don't live inside the box of just the area that you live in. There's also other investment opportunities in other parts of the world. And I know you're going to say, well, that's stressful. I'm not there. I don't know how to manage it. Just so you're aware, the typical cost for a property management company is 10% of gross rents. So if your rent on that house that we just showed that scenario is $4,200, you're looking at $420 to have a property management company take care of it for you. That still puts somewhere in the neighborhood of $1,050 in your pocket every single month, and now you don't have to take care of it yourself. The property management company is going to screen people, they're going to look for the best renters, and they're going to take care of any issues that might come up along the way. Now, investing in real estate does not come without its risks. There is the risk of market downturns, of course. We've got vacancies if you can't get a renter in for a month, and then, like we talked about, a contingency for maintenance. It's important to make sure that you bank that money, like we talked about earlier in the video, to ensure that you have that nest egg in case you have these vacancies or these maintenance issues. And one of the big things to really think about with real estate investment is it is a long-term investment. This isn't something that you're typically going to buy and flip. Now, those are out there, but they're far and few between. Cash flowing properties are all about building long-term growth and long-term equity. We've covered in this video how to look for an investment property, what it looks like, how to calculate all the expenses and figure out if it cash flows. Next, I want to share with you 3 hidden gems in Victoria where you should invest in real estate. Greater Victoria has 13 surrounding municipalities with different features that make it unique. Hiring an experienced real estate agent that can help you find the right investment property is extremely crucial, and also knowing what areas of town are best to invest your money. The first area I want to talk about is Langford, BC. This is one one of the fastest growing communities in Canada. The investment opportunities for single family homes and townhomes and even condos is extreme. This area has had significant development in the last 10 years, including new homes, townhomes, bringing in a lot of new families, making it very attractive for renters. Plus the ongoing infrastructure upgrades that are happening in Langford, it is on the top of the list for great potential for appreciation of that home. Second on the list is a town called Esquimalt. Esquimalt has a rich history and is the home of our Canadian military, making it a great spot for rentals. Just a short ways away from downtown Victoria, Esquimalt has become a very popular place where people want to just get out of the city a little bit, but want to be close enough to enjoy all that the downtown city of Victoria has to offer. The third community on my list is the town of Souk. That's S-O-O-K-E. Souk is about a 35-minute drive from downtown Victoria, a little out of the way, but it is growing exponentially. There's a ton of development going out there, and you can still buy a single-family home in the $700,000 to $800,000 range, and we're starting to see rents go up because the demand out in that area is growing with increased schools and more infrastructure. I think Souk should definitely be on your list if you're thinking about investment properties. So if you made it this far in the video, I really appreciate you staying, and I hope I provided some value. Leave some comments below, and please like and subscribe for more videos just like this.